Greetings, fellow traders. I'm Dylan, a research strategist at Pepperstone, presenting the latest weekly update on As Good as Gold. Gold has been stuck in a bit of a holding pattern over the past week, with prices bouncing around in a tight range as traders wait for clarity on the Fed's rate cut decision in September. The uncertainty around the size of that cut has made it really hard for any clear trend to emerge. Tomorrow's US CPI report could shift the odds between the two possible outcomes, which would influence gold's performance. So it's definitely something traders should keep on their radar. Since gold's price action has been pretty flat, I'll keep today's technical analysis short and sweet. After that, I'll break down the recent developments and dive into how the US CPI might impact gold prices. Let's get started. Looking back at the recent daily chart for gold against US dollar, we can see gold still trading within the $24.80 to $25.30 range, where it's been since August 19. Both the bulls and the bears tried to break out last week, but neither side really got the upper hand. If either direction gains traction, I'd be keeping an eye on the resistance at the upper edge of the rising wedge from mid-February, while on the flip side, the lower edge of the wedge, along with the 50-day moving average, should offer some support before prices drop any further. While the reason gold has been in this 3-week holding pattern is pretty straightforward to me, while there isn't much bad news weighing on the metal, we've also run out of fresh catalysts for bullish momentum. Traders were hoping that last week's nonfarm payrolls would clear up the picture, but that report didn't deliver the kind of clarity the market was looking for regarding the Fed's next move in September. The data itself was quite mixed. August job gains of 142,000 missed expectations, and July's figure was revised sharply lower to under 100,000. That's weak, and the revisions just fueled a more pessimistic view of the labor market. At the same time, the unemployment rate dipped slightly from 4.3% to 4.2%, which offered a little optimism. But with most of the new jobs being part-time, it's really hard to make a strong case that the labor market is actually improving. Despite dovish comments from, Fed heavyweights like Williams, Waller, and Gooseby, none of them gave us a clear read on whether we'll see a 25 or 50 basis point cut. And without that clarity, gold has just been drifting. So what's next for gold? Without any fresh market movers, it's likely to stay in its current range until next week's FOMC meeting. But before we get there, tomorrow's US CPI data could shake things up a bit. Consensus expects core inflation to hold steady at 0.2% month-on-month and 3.2% year-on-year, while headline inflation is forecasted to ease from 2.9% to 2.6% on a yearly basis. If the CPI data aligns with this cooling inflation expectations, I'd expect the Fed to opt for a 25 basis point cut in September. And since the market has already priced in this scenario, gold likely won't react much. However, if inflation comes in lower than expected, say if core inflation drops below 3% on a yearly basis, the odds of a 50 basis point cut increase. But even in this case, I don't think we'd see panic, since the repricing would be driven by cooling inflation rather than a labor market breakdown. Any boost to gold would probably be short-lived. So in summary, while CPI and even the presidential debate might create short-term volatility for gold, we're unlikely to see any major trend emerge until after the Fed's first rate cut is officially announced. For now, I'd continue to watch how gold behaves within the $24.80 to $25.30 range. So that's pretty much all for this week. If you have any ideas on how the upcoming US CPI data might impact gold trading, drop a comment below and let's chat about it. Stay tuned with Pepperstone for more insights and updates. And until then, happy trading!